2008, the world's most sophisticated financial institutions built complex mathematical models to guarantee their own safety. Then they collapsed. The foundation of this entire global financial architecture was an asset class called the mortgage-backed security. These were investment products constructed almost entirely out of high-risk, unverified residential debt. The 2008 collapse represented a catastrophic failure of mathematical risk modeling that outpaced any regulatory capacity to stop it. To measure their exposure to danger, banks relied on a quantitative tool known as the Value at Risk, or VAR model. This graph represents a standard VAR projection. It looks at decades of market history and outputs a firm daily loss limit. For major firms, it projected a maximum possible loss capped at $50 million. But when the crisis hit, those parameters shattered. In hours, $1.2 trillion equity evaporated, plunging balance sheets into the red. The sheer velocity of this destruction completely outstripped the market's physical liquidity. By the time traders realized what the math missed, it was too late. The chaos on the trading floor easily bypassed the oversight capabilities of the federal government. To understand the greatest financial failure in capitalist history, we must forensically dissect the specific math that built it. The raw material for this impending collapse was subprime residential housing debt. Lenders pushed what became known as ninja loans, meaning no income, absolutely no job, and no assets. Banks were eagerly approving massive mortgages for borrowers without verifying their ability to pay, injecting a staggering volume of toxic debt into the market. But the banks originating these loans had no intention of keeping them. Instead, they utilized a securitization mechanism. They would take thousands of individual, highly toxic mortgages and cluster them into a single financial product. The mortgage-backed security. Because the loans were grouped into a massive pool, rating agencies treated the volume as diversification. They stamped these toxic bundles with a AAA rating. That AAA label skewed global demand, signaling to buyers these bundles were among the safest financial instruments on Earth, equivalent to U.S. Treasury bonds. Consequently, pension funds, retirement accounts, and foreign banks bought them in massive quantities. Wall Street masked the danger of bad debt by burying it inside impenetrable structural complexity, equating severe risk with absolute safety. This entire mathematical architecture relied on a single foundational assumption, the axiom of independent defaults. This map shows how that logic was supposed to work. The math assumed a default in Ohio was isolated, having zero effect on a borrower in Florida, but a nationwide housing bubble meant these loans were inextricably linked. This created perfect correlation. When a shock hits, independent probabilities merge and fail simultaneously. When the housing bubble finally popped, the independence assumption disintegrated. One falling geographic tile pulled down the entire trillion-dollar floor all at once. The idea that bundling toxic assets somehow neutralized their toxicity proved to be a severe structural miscalculation. To understand why bank executives didn't see this coming, we have to look closely at the specific software model they relied on, Value at Risk. The VAR model generated its daily safety forecasts by continually analyzing decades of standard historical market volatility to predict future outcomes. This distribution curve illustrates the concept. VAR operated on a 99% confidence interval. It calculated that 99 days out of 100 standard market conditions would prevail, capping losses at $50 million. But the model possessed no mechanism to account for the 1% extreme outlier, the fat tail. Over a 10-day period in September 2008, the market experienced unprecedented drops. Those sudden violent shifts shattered the historical parameters that fed the model. Because the historical data no longer matched current reality, the software essentially went blind. The staggering losses accumulating on the bank's books existed entirely outside the model's capacity to measure or warn against. Mathematical safety. Models provide zero protection when their core equations are blind to the extreme outlier. While the model failed, the physical reality of Wall Street's operations amplified the damage. Packaging thousands of mortgages into securities took months, forcing banks to hold these massive toxic assets on their balance sheets while they were being assembled to maximize their profits. During this holding period, banks utilized extreme leverage. They borrowed massive amounts of outside cash to buy up as many of these supposedly safe assets as possible. Looking at this balance diagram, you can see the scale of the exposure. Major firms pushed leverage to the limit, balancing $1.2 trillion in assets on a fraction of cash capital holding. This created a precarious threshold where a minor market decline becomes cataclysmic. If the value of those assets shrinks by just 25%, the structure collapses. A 25% drop on a highly leveraged $1.2 trillion portfolio equates to a financial loss greater than the entire company's market capitalization. Extreme leverage took a relatively localized dip in housing prices and magnified it into an immediate firm-killing event. Facing total insolvency, the banking sector initiated a ruthless fire sale, aggressively liquidating massive multi-trillion-dollar portfolios overnight to clear their books. Wall Street firms deliberately dumped this toxic paper onto their own clients and unsuspecting buyers who still relied on the bank's established reputations. This screen illustrates the rapid collapse of the asset price as the wider street realized a massive panic-driven liquidation was underway. The bids plummeted, prices cratered from 96 cents on the dollar to 85, down to 73, and finally 64 cents. This coordinated dumping of worthless assets thoroughly destroyed the market. It instantly evaporated global liquidity and shattered institutional trust. For years, the most sophisticated financial institutions on Earth managed to ensure their own immediate survival only by deliberately crashing the broader market. The federal oversight agencies tasked with monitoring systemic risk were completely blindsided by this contagion. Proactive regulation proved impossible because the agencies relied on the exact same opaque AAA rating systems and flawed value at risk models that the banks were using. The macroeconomic devastation was absolute as the contagion spread $11 trillion in global wealth simply vanished, and roughly 6 million families lost their homes to foreclosure. While the corporate architecture of Wall Street was largely shielded by emergency capital, the physical collapse of middle-class neighborhoods was left to play out entirely. Ultimately, the federal government resorted to a massive reactive measure, signing a $700 billion institutional bailout to rescue the exact entities that had constructed the toxic architecture. The global economy was dismantled by an unwavering blind faith in flawed mathematics.